Hello, everybody, and welcome to this week's podcast for the week ending Friday, the 17th. How's everyone doing?
Doing all right. How about you?
Cool. I'm joined here by Jamie West. Good to see you. It's been a little bit since you've been on a podcast, and I don't think we've ever been on one together.
Yeah, I haven't done one in probably, I think since last year when we were talking about the yield curve inversion. And yeah, definitely the first time we've done one.
Yeah. So
So
hopefully it's good. Maybe this is the first of many. Who knows?
yeah.
But it's been a pretty busy week. I mean, a lot of data really hit. The markets hit the ground running when it comes to end of year. Nobody's really doing too much. Everybody's just enjoying Christmas, New Year's, and everything like that. First week, everyone's getting back from vacations, kind of getting into the swing of things. This week started off earnings, got a couple of key inflation, prints, stuff like that. So things have been moving.
Yep. There has been a lot of action going on. Although looking at the like year to date numbers, you wouldn't really know it. But there's
Right.
been a lot of movement kind of under the surface.
Yeah, no, I mean, you look at them, we were just looking at the names we typically look at, like major market representatives, Russell 2000, S&P 500, emerging markets, the dollar yield, which we'll talk about more later on. But, we were sitting there and it's like, wow, most of the domestic equity stuff is up about 1%. Now, of course, most of that is coming as of yesterday, Wednesday, the 15th action or
Yeah.
whatever, after we got the kind of cool inflation reading and markets are digesting possible rate cuts and rates kind of coming down and things like that. But, you know, wouldn't necessarily think that markets are up 1.5%.
Yeah, I mean, I think you hit it on the head. I think before yesterday, it was kind of a very different story. We were probably down slightly for the year, depending on which index we're looking at. And then, pretty good rally yesterday, kind of turned it around. So we'll see, I guess, how it plays out the rest of the week.
Yeah, and we'll see. I mean, the thing that we've been watching quite frequently has been the participation numbers, and we won't dive into all that today. We've got some other stuff to chat about, but the average stock, the S&P 500 equal weighted index has had a pretty productive last couple of days. And so, if we do continue to see, rising participation, the other 493, as we typically call them, doing well, that would, probably be a nice tailwind for markets as we wrap up January. Speaking of January, we talked about the January barometer a couple of weeks ago, Ian and I. I know you're writing a piece. Didn't really plan on talking about this one, but I mean, January barometer typically bodes well for the kind of the rest of the year, right?
Yeah, I mean, you're up in January, high percentage of the time you finish the year with a gain. So right now we're up, 1.5%. So that would bode well for the rest of the year. I will say, I think when I wrote this piece last year, we were down in mid-January, then it turned around. We finished January
Right.
with a gain, obviously finished the year strong. So,
Hoping it's not the other way.
right. I wouldn't count your chickens before they hatch because, the last 2 weeks of January, who knows what's going to happen.
Yeah. Well, that'll definitely be something. And of course, it's not just history we're looking at, right? History, often rhymes. It doesn't always repeat or whatever that saying is. But, we're looking at a lot more than just historical Januaries. And of course, there's no guarantee that a positive January means to a, positive rest of the year or anything like that. But anyways, that's something we're watching. The other stuff we wanted to actually go into a little bit deeper detail on was some of the maybe broader asset allocation changes we've seen over the last week. To kind of set the stage for everybody, Dorsey Wright has what we call a dynamic asset level investing tool. That's a mouthful, so we just condense it down to Dolly. We call it the Dolly tool, which uses relative strength matrices in the background to help identify points of strength and, more importantly, sometimes points of weakness from a broad and then intra asset class ranking. There's a lot of jargon there. Point being, Dolly just helps us figure out what's strong and what's weak. And this week we saw a pretty notable change across the kind of broad asset classes. You want to jump into that?
Yeah, we saw commodities move up ahead of international equities. Um, you know, Not what you typically see. Obviously commodities a bit more cyclical. Prices go up, prices go down. Whereas, over time we kind of expect equity markets to go up, right?
Right.
So unless there's something kind of going on, you generally expect that you're going to see domestic equities and international equities near the top of those rankings. So, notable to see that international equities has fallen. Obviously, the dollar has been on kind of a tear, and that is a headwind for international equities.
hmm
Historically, though, it's also been a headwind for commodities. So interesting to see that, it seems to be affecting International equities a bit more. They're having a bit more trouble than commodities. Part of that may be that we saw a pretty decent breakout for energy. Crude oil kind of bounced around, near the high 60s for a couple of months and then just broke out in the last week or two. We'll see if that has legs, but a pretty notable breakout for energy early in the year.
Yeah, I want to go back to one thing you mentioned, talking about how the US dollar can be a headwind for both international equities and then commodities as well. I think the international side of things makes sense for a lot of people, right? When you've got international buyers having to buy things against a stronger dollar, that's going to hurt their bottom line. Do you want to go into a little bit more detail about maybe why a stronger dollar is a headwind for commodities, just for the listeners?
Yeah, I mean, sure. Just mechanically, I mean, commodities are priced in dollars. So if the real price of the commodity stays the same and the dollar goes up, then the value of the commodity in dollars has to go down if that real value is staying the same. If you could take like an average of its price in all currencies and that kind of stays the same, and then the dollar goes up, that kind of average price is going to have to go down
Hmm.
to kind of maintain that true value.
Yeah.
And then also, some people look at the dollar as a risk on, risk off indicator, falling dollar being risk on because people are buying emerging currencies, international currencies, moving away from the safety of the dollar, and then a rising dollar being risk off.
Hmm.
So you have the kind of mechanical reason, which is commodities are priced in dollars, and you have the more esoteric, risk on, risk off nature of the dollar.
Yeah, no, it's a good thing. I actually put a piece together yesterday, and kind of just as people have called in, clients have called in, the commodity space and picking up commodity allocation within a portfolio for some of these advisors and money managers and things like that sometimes feels like the Wild West. I mean, you're dealing with a lot of different types of structured products, a lot of different, we talked about it yesterday, some tax qualifications that you're dealing with. So, it can definitely be a difficult area to navigate, and understanding how all of these inner workings work with each other can be, kind of sometimes half the battle. So appreciate the color on that for sure.
Yeah, I mean the commodities, for the big ones, oil, natural gas, or just broad commodities, not too difficult for anybody to get exposure. But if you're looking to target like an agricultural commodity, it gets pretty complicated. You may be looking at some pretty thinly traded funds.
Right, you're looking at cocoa or
Yeah, exactly.
right. It's
Which,
like you want the asset that did better than Bitcoin last
yeah,
year, right? Was that on your bingo card?
coca, no, that was not.
Well,
Uh-huh.
maybe for this year we'll see.
But I doubt it was on many people's bingo
Right.
cards unless you happen to be a cocoa trader.
Right. We're correct. That maybe that helped. But going back to some of the energy stuff, I mean, we've seen the energy. So going back to Dolly, right? Underneath each one of these broader asset classes, we can then break down that asset class into different subgroups. So, for instance, commodity, you have base metals or industrial metals, precious metals, agriculture, and energy focused areas. Now, energy was at the bottom of the rankings until just, I would say, last week or so, and it's actually now up in first place. Now, energy can move around quite frequently, as we all know,
Yep.
but it has been a point of relative strength, at least in the near term. It's seemed to pick up some longer term strength as well. What are you looking for when it comes to, does it have staying power? Like what are you looking at from an indicator perspective, maybe different price points or anything like that? What's on your mind as you're looking at for that?
Well, I think first I'd mentioned natural gas, and you mentioned just some of the volatility in commodities, and there aren't many that are more volatile than natural gas. I mean, it will be up and down 5% just on any given Tuesday.
Right.
And we did see a big move out of natural gas over the last week or two. I think when I looked, it was up over 15% year to date.
Hmm.
We've had a cold snap here on the East Coast. So that may
No
be
water in Richmond. I
no
don't know.
water. Yeah, no, that may be helping to drive up, some natural gas prices. Heating oil also had a big move. So some of that may be just kind of cyclical that, we're seeing this cold snap across the US driving up those prices. Um, I do think that the breakout that we saw in crude looks like it may be a little bit more durable. Crude had kind of, and maybe we can put the chart up on the video. Crude had put in kind of a series of lower rally highs since
Mhm.
April. And then with this recent rally, you kind of saw it break above its October high. Now, whether that actually leads to a continued upside. I couldn't say for certain, but I can say that, that kind of trend of lower rally highs has ended with this move that we saw.
And that's going to be a good thing, right? I mean, like when you look at technical support resistance, we want to see, establishing support, which crude, if you look at back at that chart again, which we just threw up on screen, nice, layers of support down there, multi-year lows that we're bouncing off of. Bulls are pretty content to defend that level. And then, like you said, breaking past these levels of old resistance where buyers just couldn't get through before. So yeah, I mean, you look at it from an equity perspective, the energy space from a sector perspective perked up, has not translated into super long-term strength quite yet. That's perhaps what I personally am looking for, is that where's that translation? Because again, talking about where advisors or where money managers are picking up exposure, it's probably more likely they're going to go pick up XLE than they are going to go pick up,
USO.
yeah, USO, right?
Yeah.
So, where does that sit, and how well does that do from a sector perspective too?
Yeah, I mean, obviously, energy is still sitting at the bottom of those Dolly sector rankings. So we saw a pretty decent move in XLE. It's shown some improvement recently, not enough that I would say that the picture has turned positive. Um, but there's also a lot of moving parts. Last year we saw coal stocks doing really well when there was all this talk about China stimulus, and
Mhm.
that's kind of turned the corner and they're getting beaten up. So, there's kind of a lot of different areas in the energy equities that you don't really have to worry about. Refiners, they don't just have to worry about oil prices going up. They also need gasoline prices to go up because they're worried about the spread.
Right.
So, we can see crude oil go up, and it's going to benefit the integrated stocks, XOM, CVX, that
Hmm.
kind of take it from start to finish. But some of those that are more midstream or end stream, they may not necessarily just benefit just because oil prices have gone up.
Yeah, and that's a really good point. I mean, when you think about energy, or you can take this outside of just energy specifically, you think about like what areas are affected and then what areas are going to be more affected positively than others. And that's where I think in most cases relative strength can really start to flex its muscles, because you can start to say, okay, well, from a relative perspective, this is going to impact this point more than it's going to impact this point, or it's going to impact A more than it's going to impact B, and stuff like that. So using relative strength to say, okay, well, where is where is price actually moving? Where is price falling, or where is it rising? That can be a big key as well.
Yeah, I mean, I think you can have a hypothesis of how things should work out, but relative strength is good because it's going to be like, okay, is this confirming
Yeah,
what you think should be happening? Is the price action actually kind of moving things the way you thought? And if it's not, then maybe you need to go back and
right.
kind of
Evaluate.
rethink about your
Yeah, something in
hypothesis.
there you were not seeing or whatever. The market just doesn't agree.
Yeah.
Interesting thing. I mean, there's a couple different ways we can take this, but the next idea is, you look at precious metals, points of strength, right? Previously, precious metal is doing pretty well. You know, gold is still doing pretty well. I mean, when you look at it year to date, it's up about 3%, building on top of a pretty productive, 2024 and 2023. Now, that's not up as much as crude is year to date, but gold, precious metals in general have kind of tapered off a little bit. What about rates coming down? What about the rate environment and kind of that relationship are you watching as we move into 2025?
Yeah, I mean, I think it was surprising to see the magnitude of the move that we saw in gold and silver last year, just given where rates were.
Mhm.
Um, you know, Anecdotally, they've said that, central banks were busy buying up gold, driving up the price. But really, I mean, you tend to see gold and silver move opposite yields. And we were still pretty elevated in yields last year. So to see all these people buying an asset that doesn't, have a yield when you could have been buying treasuries that were putting off 5%.
Right.
It was an interesting move. Um, Obviously it's cooled a little bit. We'll see if, the kind of move down in yields that we've seen over the last day or two is going to kind of help boost gold. It is interesting that it's up year to date when we have seen the dollar kind of strengthening.
Hmm.
Typically it's a commodity, so it doesn't do as well in a rising dollar environment. But I think usually the key is yields, and that relationship hasn't necessarily held over the last year. Now, maybe you can say that there was some anticipation of big rate cuts this year,
Right.
and that may or may not be happening. But
We'll see. Right.
yeah, we'll see. So, it's possible the market kind of got ahead of itself with the precious metal rally that we saw last year, thinking we were going to get 5, 6 cuts this year, and that may just not be in the cards.
Yeah, and to provide some more color about that inverse relationship, just like Jamie did with the kind of dollar to commodity space, the point of that inverse relationship is as he mentioned, why go buy a kind of non-yielding asset that is proposed to be kind of a safe store of value? Why go put gold underneath your mattress when you can go buy a U.S. Treasury that with a higher yield? So that's kind of the origin of that inverse relationship. Just talking about when rates are going up, the opportunity cost of owning some of these precious metals as a kind of safer asset is going to be higher. It's going to be a higher hurdle for those guys to jump over. So that's kind of where some of that stems from. What else are you watching? I mean, just precious metals in general. From there you can talk about yields, we can talk about earnings and kind of the banks and their type of stuff. So what do you think? What do you want to talk?
I mean, I think yields right now, very interesting story. We saw the 10-year yield eclipse its 2023 high. I thought a pretty surprising move. We really haven't, the Fed futures market, not even yet pricing in the possibility of a rate hike. But we saw, rates move higher than they did last year, even though the short end is below
Mhm.
where we were then. Um, I think it'll be interesting to see. We've seen it kind of back off the last day or two. We didn't quite get to the 2023 highs. That, upper fours, just 5% level has really been kind of a ceiling for yields. Um, if it acts as a ceiling again, then, I think that will probably be beneficial for equities. If we kind of break above that 5% level, we'll kind of see, I think there's been some speculation that, stocks could be in trouble if we kind of take out that 5% level on the 10-year yield.
So what are you watching for that? You watching inflation prints? I mean, like what do you think is the new driver of that type of stuff?
I mean, I think inflation is going to be important. I think there's also just some things that are harder to quantify. There's concerns about the US debt level, concerns about the potential impact of tariffs.
Hmm.
And, those are a little bit harder to quantify, especially because, Trump is going to be inaugurated next week. It'll be sometime before they're able to put policies in place, and then sometime from there before you really start to see the effects.
Right.
So to me, it's a little bit more of an unknown. You can probably generally we have a consensus estimate for inflation. Usually it's pretty close, but I think these things are going to be a little bit more of an unknown.
Yeah, we'll have to see, especially with the lag that you mentioned on possible inflationary pressures of the tariffs. You think, let's just say, 2 months down the road, inflation kind of is coming down, markets like all that stuff, and then suddenly you start to see inflation rear its ugly head back up again, and people get a little bit concerned because now we're pricing in rate cuts, and suddenly maybe that isn't the case, and you get revisions. I mean, it's what came first on some of this stuff, the chicken or the egg, but you could definitely get a little turned around. So
Yeah, and if there are tariffs and we do see the economy start to cool a little bit, I mean, I think you could then see rates move very quickly the other direction. I think the market kind of set up now is possibly set up for a pretty big reversal. High yield spreads are trading at their lowest level since about 2007. Meanwhile, yields are trading at their highest level since about 2007. So I think there's a pretty decent, possible setup for we start to see the economy cool, and all of a sudden you see yield spreads start to widen and treasury yields start to come down, which would really be kind of a reversal of where we've seen relative strength in fixed income over the last couple of years.
yeah. What else? I mean, we're hitting all the stuff we chatted about before. I mean, do you have any other earnings stuff? We got earnings started up this week with the big banks and kind of getting that whole cycle going up again. Seemed like most of the bank earnings were quite good. Financials in general is ranked from the top at the top of our sector rankings for going on a couple months now at this point. So it's been a point of relative strength. What are you watching from a financials perspective? Are you looking at small caps, kind of regional banks and things like that for participation? Or are you really just thinking that markets are kind of going back to a core driven market here?
I mean, it certainly seems like we're seeing a lot of dominance out of those mega cap names. I mean, I think what the S&P was down 2.5% in February. I mean, I'm sorry, in December. Um, Meanwhile, the Magnificent Seven had an average gain of about 5.5% for the month. So, you know, the mega caps just kind of smile and keep on coming. Not anything that we've seen thrown at them so far. I mean, you see a stumble here and there. Nvidia was down like 12% over a few days, but Nvidia moves 4% a day, so it's.
Right.
But yeah, I think we're still seeing a lot of that strength out of the mega caps. I think Goldman Sachs, JP Morgan all had strong earnings. Um, so I think that's a positive sign for stocks overall. I mean, banks pretty economically sensitive.
Yeah, certainly. We'll have to see. I don't know the exact schedule of what's happening next week or anything like that. Do you know what the next big report is
I
to go?
I don't think I think we get into big tech earnings the week after next.
Okay.
Um, so
Well, then that'll be exciting, and I'm sure we'll talk about that in a few weeks when it comes to the podcast. You have anything else, other thoughts for today or anything?
no, I mean, as we said, I think there's a lot going on. I think the back half of January is definitely going to be interesting, and we'll see how that barometer shakes out.
Certainly. Yeah, that's the end all be all,
Yeah,
right? So
absolutely.
cool. Well, listen, we appreciate your time today, and we will be back again next week. Hope everyone enjoys the long weekend and everything like that ahead. Otherwise, we'll be back again next week to touch on any updates. Thanks.